Hello and welcome to the Global View on this Monday. I'm Andrew Gagan. Good to have you with us. Well, let's check those US Treasury yields. They hit 16-year highs on Friday after data showed 336,000 jobs were added in September, almost double the number expected by economists. Data for August was also revised higher, pointing to persistent labour market strength that could prompt the Fed to raise interest rates again, although wage growth is slowing. Monthly wage growth remaining moderate, with average hourly earnings rising 0.2% to be up 4.2% for the year. The yield on the benchmark 10-year note reaching 4.88%, the 30-year yields at 5.05, both the highest since 2007, and the 2-year was as high as 5.15%. The US dollar did ease against most major currencies on Friday as investors assessed the jobs data. The Aussie dollar trading at 63.6 US cents. We're looking at the commodity market, and oil continued to track higher with US crude futures up $2 to $85 a barrel. Investors preparing for further spikes following the outbreak of conflict between Israel and the Palestinian militant group Hamas. Israel striking the Palestinian enclave of Gaza over the weekend, killing hundreds of people in retaliation for the Islamist group's attack on Israeli territory, which is estimated to have killed 700 Israelis. Well, gold prices gained on Friday, helped by a technical rebound after a 9-day losing streak. US gold futures 0.7% higher at $1,845 an ounce, and gold will also be in focus for investors given the rising geopolitical risks from the outbreak of conflict in the Middle East. All right, well, for more on those macro factors and a look, particularly what's influencing the US consumer wallets, Anthony Doyle joining us from Firetrail. Anthony, good to see you.
Morning, Andrew.
Yeah, of course, we can't avoid what's going on in the Middle East at the moment. What sort of implications are you looking at the moment from that outbreak of conflict?
I think in a very short-term sense, any conflict within the Middle Eastern region obviously brings to the fore concerns around what the impact will be on the oil price, as you've just mentioned. So undeniably, we're likely to see oil prices move higher. I expect risk aversion to increase even higher than the levels we've seen over the last couple of weeks with the increase in long bond yields that we've experienced. So typically what we'll see is a flight to safety. So arguably, despite the strong jobs data on Friday, we may see Treasury yields decline, the US dollar strengthen, and other safe haven bids increase as well, such as Japanese yen and Swiss franc, for example.
All right, well, you mentioned that jobs number out of the States on Friday, as I said, double that was expected. But I guess the focus really for markets was on wage growth, which had moderated. What's that telling you about the state of the US economy at the moment, and I guess particularly as far as what the consumer is doing?
Yeah, it's really Goldilocks, as you say, so stronger than expected absolute payroll numbers with strong revisions to prior months, yet wage increases, the increases in the rate of growth starting to decline. And more important inflation numbers out this week, obviously, with the CPI. Now, looking at the US consumer, we can see two real impacts on household balance sheets this year. One has been the increase in oil prices that we've experienced over the last couple of months. So whilst year on year, the oil price is lower, gasoline prices have actually risen by around about 12% in the last 3 months. The other interesting dynamic is that student loan debt repayments have begun again, and they began from October the 1st. And in the US, this is a big deal. $1.1 trillion of student debt outstanding. So typically, it's around $350 a month for the average US household balance sheet. So in combination, there are some growing headwinds for balance sheets in the US, which can be offset by drawing on savings. But an analysis of the US consumer spending habits suggests that whilst high-income households can in fact draw down on savings, at that real average level, median income household level, the household balance sheets are really balanced quite finely at the moment. So any increases in oil prices, gasoline prices, student debt, you will see that start to impact on spending.
All right, so as you mentioned, certainly those higher income households can draw on those savings, although they are being run down rapidly, and I guess we're seeing that with those on lower incomes. So you talk about the impact then for consumer spending. How's that likely to play out, do you think?
We think you want to be really cautious on any exposure to names that have predominantly lower income households that are consuming the merchandise that they produce, such as apparel, for example. And you want to be more focused on names that are potentially more resilient to any sort of spending declines or reduction in spending. So you want to be wary. We are seeing inventory build up in places or in companies such as Nike and Adidas, for example. We do expect destocking to occur. We do expect discounts to begin. That will obviously have an impact on earnings. So there's some of the names that you want to avoid. You want to avoid any companies that are particularly levered in a higher interest rate regime. Now that said, you obviously do want diversity. You do want some exposure to the consumer because at this point in time when it is extremely volatile and the outlook is extremely difficult and uncertain, you want that exposure at different areas of the market, different places of the economy, because of the outcomes are so uncertain and variable at this point in time.
So you're saying perhaps in that environment then avoid apparel, as you've mentioned, but consumer electronics, home appliances.
Yep.
If you're avoiding those, where do you focus then if you still want that exposure?
Yeah, so as I said, we are building a portfolio of value and growth names, cyclical, defensive, and so you want exposure throughout the cycle to the market. And so where we are looking at in particular for exposure to the US consumer is in a really defensive consumer discretionary name, a name AutoZone, which Australians may not be used to, may not be familiar with, but essentially they're an auto parts stockist reseller. The $45 billion market cap, trades on a 20 times PE, and since listing over 20 years ago, management have bought back 90% of stock.
Well, we take a look at the share price there, and certainly over the past 5 years, that's an impressive looking chart.
Yeah, so they've been able to consistently grow market share, grow earnings, and there's two really key components of what matters for AutoZone. Firstly is the exposure to that retail consumer, as we've been discussing. So we know that the legacy, the car fleet in the US is growing older, and so we expect an emphasis to continue on the retail consumer to perhaps undertake motor vehicle repairs themselves.
So you're saying that's the focus rather than actually, because they won't be able to afford a new car, therefore you've got to keep your old car on the road.
Well, yeah, exactly. So you have to run your old car, and I'm sure this is a similar thematic in Australia as well. We know that car loan interest rates have increased materially. So rather than buy the new car and the cycle that people typically have done, they're going to run their old car for longer, their used car for longer, particularly as we've seen used car prices decline by around about 15 to 20% since those COVID levels experienced over the last couple of years. So you will see an emphasis on repair and replacing rather than buying a new car. And for the more professional market, the mechanics, they absolutely love AutoZone. So if you're a small business like a mechanic, what matters is how quickly you can turn over these repairs. And AutoZone conduct 3 or 4 auto part deliveries every day. So they have built somewhat of a segment or somewhat of a moat around their key mechanic and professional services unit, to stave off the Amazons of the world, for example.
We are, of course, Anthony, seeing that transition from the petrol guzzling car to EVs. Are they positioned in that market as well, do you know?
Yeah, so they are. They sell a lot of the Tesla parts as well. But that said, it will take a considerable amount of time before the ICE vehicle fleet is entirely replaced by EVs. And Norway is a good example of that. So almost 100% of new car sales are EVs, yet ICE vehicles are about 90% of the total fleet. That's not to withstand that you find that ICE vehicles, they have 20,000 vehicle parts versus a battery-powered vehicle which has around 20, so less moving parts, but the battery vehicle is harder on brake pads, steering columns, etc. So we will continue to see demand from both parts of the legacy vehicle fleet, both ICE vehicles and EVs.
But is that potentially problematic in just in terms of ongoing revenue for a company as you see that focus on EVs, simply because, well, there are fewer parts that wear out?
Yeah, I mean, you're talking a long way in the future,
yeah.
Particularly in the United States. So a huge vehicle fleet. And don't forget that a new EV is particularly expensive relative to an ICE vehicle as well. So you're talking about a trend that's likely to be some way off in the future, almost 2 decades away.
All right. Anthony, before you go, more broadly in the States, Are you comfortable with valuations as they're out at the moment? Of course, we saw September, that seasonality came to the fore, fairly heavy sell-off. How are you looking at valuations at the moment?
Yeah, so I think that those magnificent seven stocks that have driven the market and are a significant part of the market today, if you're looking at the S&P 500 at that index level, it can appear quite expensive. So where we are really looking at opportunities is more in the mid to small cap part of the market globally. And we are seeing fantastic opportunities on a 3 to 5 year view. Certainly in the short term, there is a significant amount of noise around interest rates, inflation, geopolitics, the oil price, economic growth. But if you pare that all back and focus on what the underlying drivers are for a company, particularly those companies that have a sustainable business model and do have that ability to grow their earnings over the medium term, well, share prices follow earnings. And we think there's a considerable amount of alpha that investors can generate. Come away from the headlines and actually think about the core fundamentals of businesses. And it is really a stock picking market today.
Anthony, great to get a view of your strategy at Firetrail. Thanks for joining us.
Cheers, Andrew.
All right, that is the global view. Just before we go, let's check. That's where we're expected to open in just a couple of minutes' time. Stay with us. The open is just around the corner.